Islamic finance is a method of finance which is based on the principles of Sharia. Sharia has two main sources, being the Quran, which is the equivalent of the Bible for the Muslims. Many of these principles are common to the three main religions in the world, being Christianity, Judaism, and Islam. Judaism and Christianity moved away from certain principles and started accepting new methods of financing, which until to date Muslims do not accept. The main differences between the two types of financing revolves around the charging or not of interest. Whilst in the conventional finance system, that which most of us are used to, accept the fact that money generates money and therefore interest is charged, for example, when one goes and takes a loan from a bank. In the Sharia principles, this is not acceptable. Why? Because the main principle is that money needs to be earned. You need to take risks to earn money, and no one can make money out of this simple fact of borrowing money to another person. Consequently, the main concepts of banking changes. Whilst in the conventional world, a bank lends money and is allowed to charge interest, in an Islamic bank, the bank needs to participate in the project, in the activity that it is financing, and consequently it is sharing risk and sharing profit with the person entering into such activity. It is also sharing loss. So if there is some insolvency or some bankruptcy, the bank will suffer the loss as well as the entrepreneur or the other person that is basically financing that activity together with the bank. There are other principles that banks in the Islamic finance world cannot finance. For example, the production of alcohol or alcohol-related activities, anything to do related to pork, anything whereby animals are killed in a non-Sharia compliant manner. It cannot finance weapons or drug dealings or anything that intoxicates the body. It cannot finance activity that is considered gharar, meaning that there is a high uncertainty in that activity. In our world, for example, conventional insurance is considered as highly uncertain, and therefore an Islamic finance institution would not be able to finance or have anything to do with the insurance as most of us are used to in the Western world. So although there are various activities that are done within Islamic finance that are common to the other two main religions in the world, there are then specific things related to Islam itself. As I mentioned before, for example, the pork-related activities or the alcohol-related activities. It needs to say that in the business world, particularly when it comes to project financing, this method of financing is very popular because even the bank is sharing the risk with the entrepreneur. Nevertheless, in economic areas like the European Union, this may not be so popular because the legislation does not allow for it. The concept of banking accepted within the European Union is different from this. Nevertheless, there exists instruments like the Trust and Trustees Act in Malta that may act as an intermediary legal institute to finance certain projects through Malta in the Sharia compliant method.